This is a 1 month program, free educational program we are conducting. You all are the participant of this 1 month free educational program initiative of Smart Finance. Here our objective is to teach you some valid concepts of the market. So valid trend forecasting or the market forecasting concepts you will be learning in this particular program. And the concept what you are going to learn today is known as the one standard deviation concept, and this is a beautiful concept. And from the past 30 weeks we have been giving the weekly trend forecast using this particular concept, and out of 30 weeks 29 weeks it has given amazing success. Consistently it is going on giving the weekly success. And if you use this particular concept in its real essence, then you will be definitely get benefited out of this concept. And intraday experience of many traders also very good for this particular concept, and it is a very consistent method so far. So moving into the subject, one standard deviation, 1 SD, is just one of the concepts known as our one standard deviation. So what is a one standard deviation? So what is known as a one standard deviation? So whenever we talk about this term called standard deviation, this is known as a statistical parameter of estimation of volatility. So this standard deviation, in the very layman's language, if I can say, suppose in your family you are calculating that average every person in my family will be consuming 100 grams of grain in a day. However, this is the average. Some member of your family may consume 60 grams, some member of your family may consume 110 grams, some member of your family may be consuming 70 grams. The deviations from this 100 to 110, 100 or 70 or 60, that is known as your mean deviation. Average, you are saying that 100 grams per head will be using, however each individual is using a different. So that deviation is known as your mean deviation, average deviation. Same way, when we talk about the one standard deviation, here the concept says that if I am considering any of this parameter like 5 days moving average, 10 days moving average, or 100 days moving average, 200 days moving average, whatever the concept I am following in the price term, if I am saying that there is a 100% probability that that price point will be get violated, that price point will not be obeyed by the market, then it is known as your one standard deviation. Suppose if you are saying that 5 days moving average of the nifty future is standing at 7600, this is the 5 days moving average, then this one standard deviation says that there is a 100% probability the price can move above 7600. There is a 100% probability that price can move below 7600. So that is what the definition it says. So this deviation is a truth of the market. So this deviation can be plotted mathematically through one formula known as your one standard deviation formula. So once I go to this one standard deviation formula, what that formula says, here you are just, it's a very simple formula. It is saying that price at which you are trading, volatility, this is a very catchy term in this particular formula. Square root of days to hold, if in intraday you will be saying that it is 1 divided by square root of 365. So this is the price range. First initially the definition says that there is a 100% probability price will never obligate your moving average. Second part says that if it is not obligating this price range, then where it will move, whether it will move up or down. So here this says that the expectation of the price move is calculated by this particular formula. So if the price is violating this formula is giving you 100. So you can say that either it can go 100 point up or 100 point down. That is what it concludes. So one standard deviation, the standard deviation from any mean position is saying that if there is a deviation, the deviation can happen by how many points. Once you get how many price points you are getting, then you can directly use that price range in your Fibonacci ratio or Fibonacci proportions to identify the trend and enter a trade and get the result. So that is what you are going to do. So in the Fibonacci sequence, yesterday I have told you there are different levels of understanding in Fibonacci. So Fibonacci retracement is one of the understanding. Yesterday also I have told you what is the difference between a static and a dynamic Fibonacci principle. So today the same ratio principle I am just uttering here. I am saying that these are the Fibonacci ratios 0.236, 0.382, 0.5, 0.618. All these things are the Fibonacci ratios. And using this ratio, what we are going to do? What objective you wish to achieve? As a trader, what is your objective? So here some traders say that 5-minute candle, 1-minute candle, 2-minute candle. So whether as a trader you are sitting in front of the terminal to count the number of candles what is appearing in the screen, your objective is to make profit. No trader enters to the market with the objective to lose money. Whenever you enter to a market with the objective to earn profit, that time your base work or your homework depend upon how successfully you identify a trend. So identifying a trend means where your uptrend and downtrend will start, the starting point of the trend, uptrend and downtrend where it can have a probability to reverse, uptrend and downtrend where it will saturate. So this is the objective you have to set and work on that direction. So where the trend starts, where it will reverse, where it will saturate. So Fibonacci tells a very clear understanding. So 0.236 retracement above your, this is the ratio, sets the trend. 0.382 confirms the trend, and once you enter to this 0.618 to 0.786, there is a high probability to reverse from this particular point. And if you successfully penetrate this price point, then you have a probability to touch 1.236 and 1.618 retracement. So this is what, and 1.618 or 1.236 is known as your saturation point. 0.618 to 786 is a reversal point, and starting point is 0.236 to 0.38. This is what you have done. But one thing you have to remember, whenever you do or follow this particular method, that doesn't give you any guarantee or warranty that it is from 0.38 to it will never reverse back. This is just a method, and this doesn't give you any guarantee or warranty that once it crosses 0.382 it is going to definitely touch 0.618. That doesn't give. Any method you follow, any calculation you follow, that doesn't give you any guarantee that yes, the trend breakout happened and success is sure, no failure is going to come. Or once 0.382 is crossed, you are definitely going to get the success, no failure you will come, no loss you will get. That never says that. So then you must ask me, what is the meaning of the trend forecast? Why should I do all this calculation if there is a no guarantee and warranty? So my simple answer is that whether so far any method exists in this domain which gives you that particular guarantee, if it is there, then you just reject this method and go with that particular method. This is a trend forecast. You are just doing one estimation. So a good trend forecast is that once you calculate, and if the market obliges that, market follows that, market obey your calculation, then only it is known as a good trend forecast. So this is one of the good trend forecast method where the maximum probability of getting the success is there. So that is why I recommend this particular method. So our objective is trend starting point, downtrend or uptrend downtrend reversal point, and saturation point. So this is what we are going to do from these things. And one standard deviation, you have the formulae also I have explained you. Now move back to this particular example. So now I am just going to describe for the weekly trend forecast, which is going to give you the success or giving you success from the past 30 weeks. And you are, this is the 31st week's level I have calculated. The Nifty future, the real time estimation of this volatility comes around 11.92, which is a domain of hours. So do not ask me from where I got this 11.92. This is a prototype of the smart finance. So this is the real time estimate. You can get the volatility estimate from the past 10 days data. However, the volatility what we are considering for this projection, it is a real time estimate which gives you a greater correct accuracy. That is the volatility of Nifty future. Then Bank Nifty having the similar way, 19.72 as the volatility for yearly volatility as per the real time estimate. Then we are coming to the last traded price of the Nifty, which is closed today. 7583 is the last traded price of this Nifty, which has happened today. And Bank Nifty also having 15,670. So based on this estimate, we have calculated the expected price range as per the one standard deviation. We have multiplied that price range what we got along with the Fibonacci ratio. So for the coming week, the trend is translated in this particular form. If the price move above 7613, you will be purchasing Nifty future with the expectation of a target of 3045 and 66. So all things are one target. However, I am setting that once it is sets the trend and confirms the trend, you have a probability to move 7660. So then you can get some sizable target. Post which it is going to enter to the death zone, and once the death zone is crossover, it is going to give you 7694, post which 7737, and post which 7786. Similar way I have given for this Bank Nifty. Now here question comes. Here your trend set point is 7612, trend confirmation point is 7630, trend reversal point is 76602, 7681 in the uptrend, and once it is going above that, trend saturation point is 77382, 7785. This is the trend saturation point. And downtrend, similar way, trend confirmation comes at 7535, and reversal where the maximum chance is that trend will reverse 75506 to 7484, post which the saturation comes to 7428 to 7380. This is what it is being given. This is the groundwork of the 1ST. Now question comes, as a trader, how I can take the benefit of this particular level? Though it is a weekly level, similar way you can trade in the intraday. So here, to follow these particular levels in a most successful way, you need to understand the Fibonacci principle in detail. What it says. If the trend changes and comes to 7553, then my entire trend has changed. Then I may shift my view from bullish to bearish. So if you are buying at 7613 and successfully you have crossed 7631 and also it has gone to that first target, whether this is the time you should book the profit and come out, or you should hold it for some time. So here I am saying that till your 0.382 retracement is not violated, if you have given a buy entry, achieved the target. This is the most important part of the implementation. Those who used to say, I have a software, I am not able to use it effectively, for them it is very, very important. Listen it very carefully. If you got a buy entry at 7613, also achieved 7660 as a target, whether it is the saturation, I should come out? No. Now for your buy entry, you have kept a stop loss of 7553. You got a buy entry, you got a fast target. Now you trail your stop loss to 7630.82, round it to 7631, which is 0.382 retracement, and wait for this death zone to penetrate, or the reversal zone to penetrate. If this reversal zone penetrates and goes to the 0.888 retracement or 0.786 retracement, just trail your stop loss to 0.5. If it reverses from here, still you have a profit, though you will sacrifice few points of the profit. However, it is meaningful to hold the trade for a higher target. And if it is moving to 0.888 level, then you are thinking that yes, the saturation of the trend is approaching, then little be conservative and move your stop loss, trailing stop loss, to a closure level of 0.786. Because after touching this 1.236, if it enters this death zone level, then there will be a clear cut trend reversal will happen. Hence, trail your stop loss to 7682 and hold the trade if the price move above 7694. There is a very small difference of 13 points you may sacrifice if this 0.786 it is going to trigger. However, your profit is 21 points more than the 0.618 retracement level what you have kept. And if it is not triggering, then 0.1236 it is coming. Trail your stop loss to 0.888, and similar way you can go on trailing till you got the final target. Once you got a final target, that is not the end of the trend. Trend may continue for the second cycle or third cycle in case of a great volatility. But better come out and quit the trade and enjoy the profit whatever you have earned. So this is how you should use the trailing stop loss. And for every trade, always I recommend that you should hedge it. You should hedge it with things. Normal practice of the trader, I do not know how that concept of non-protected trade has entered to the trader's mind. It is by the broker or by the self conviction of the trader. However, 99% of the trader never manage their risk. If I say that you manage your risk with an option hedge, they say that why should I hedge? Because first you used to see the profit. I got a very fantastic question before starting of this event also. Someone has asked me how much profit I can earn per day, how much capital I require to earn profit of 2000 rupees per day. I do not know the participant's name. However, one question I got, very fantastic question he has asked. How much capital you require to earn 2000 rupees profit per day? So my kind advice is, if that is the mindset of a trader, without visualizing the risk of trading, if you say that how much I need to make a profit, then I can say the trader is so far not matured for the trading business. He is not matured for the market. He need to introspect and sit without trading for few days or few months. Then only he should enter to the trade. So this is the difference of our trader's mindset. Once you enter a trade at 7613, try to hedge it with the option of 7553 near. So 7550 put option, nothing wrong if you are taking 7600 put option. If trend reverses, then you will be definitely get protected. I'll give you a very fantastic example. Last week we have given a trend forecast. for 4th to 8th April. Monday, it has given a trend breakout at 7785. And as per this calculation, trusting on this particular calculation, we entered 7785. And for that particular trade, 7716 was the stop loss. Stop loss triggered on Tuesday, 5th April. 70 points of losses it has taken in the future. However, the option which was got hedged at 90 rupees was trading at 120 rupees and 30 points is got recovered. So net you have just lost 40 rupees. So more than 50% of your loss you have recovered from a hedging trade. Same way, once you reverse your trade and enter into the short trade, that too also I have told to hedge it with an option. Yes, you win 94 points on the same day. You lost 32 points in the options, but still profit comes to 4,600. It is with the estimation of 5th April. 6th April, the view was entirely different. You have fall below 7,600 level and you have also come down to 7,570 level. Below that 7,548 level also you have come. So in that process, if you can calculate, the profit was little expanding. So whenever there is a trend reversal, there is a uncertainty, when there is a change in the view of the market sentiment, that time you will be get protected. So that is the benefit of hedging. Whether you accept it or not, that is the only way to earn money in the market. Whether you accept it or not, whether it is a point blank, I can say, whether you accept that why I should hedge, why I should not hedge, I'll just put a stop loss and come out. But you put whatever the question you want, but this is the only one way to earn money in the market. You have to hedge. There is no other shortcut for this method. So though I have given a simple method to buy a option, you can think of selling a option also. There is nothing wrong in that. You can follow any kind of hedging strategy, but the hedging is must. So this is how you should trade in this particular method. Now coming back to, this is the weekly trend. So the trend report what we are publishing, it is a weekly trend and it is valid for entire week, starting from Monday to Friday. Whenever you are doing the similar calculation for intraday, then this is the only one changes will be there, because one day will be your movement, and for that particular one day, reference price may change, because maybe it is the gap of opening price will be there, maybe sometime current price will be there, sometime it is previous day's last trade will be there. So reference price based on where the price is opening on Monday, so based on that only it will be set, and you will be just changing that parameter, you will get the intraday levels. Intraday also I'll recommend the hedging. You may say that buying a option invites the premium decay in the intraday trade if there is a range bound market. Nothing wrong if you are buying 7594 level, nothing wrong. Intraday you are expecting till 7659. So sell a 7650 call option, or sell a, if you are buying at 7594 or 7600, nothing wrong if you can sell a 7650 call option or 7700 call option. So but hedge. So that is the only one theme of the market. And some of the traders, they ask, I used to trade in the equity, how to hedge it? So equity means your objective is very small. If you are doing the trade in the equity, then why you are taking the broker's margin and taking 2 lakhs, 5 lakhs worth of intraday unprotected trade? If you are using the broker's margin and taking 5 lakhs, 10 lakhs worth of open position in the equity, then better shift it to futures and hedge it, because you are taking that much of risk. Whether it is equity or future, it doesn't matters. Only you are taking that much of risk. So the risk must be hedged. So, but if you are doing in a very smaller amount of 10,000, 15,000 on the equity, nothing to hedge, because your exposure to the market is very low. In that case, there is no principle to hedge. Now question comes, how successful this one is in the uh, commodity trade. Yes, this is also highly successful in the commodity trade. However, only one demerit of that things is that commodity trade you cannot able to hedge, so you have to go strictly with the stop loss. If stop loss comes, you have to exit and you have to reverse your trade. So this is how you uh, trend report 22% of the people are not getting. So I'll just see who are the people not getting and we'll definitely add you in that. So I'm just going to ask you the second survey, how easy it is to follow this weekly report, whether it is easy for you to follow that report or you are finding any difficult, or it is not easy, or it is too difficult to follow. So based on the view, so we'll be changing our format so that it can be user friendly. So is it easy for the people to follow or not? Because after all, you are the people to use it, so you need to say your view. So whether you are able to follow that particular report easily, or you are finding difficult to follow, or it is slightly complex for you to follow. So give your mid answer if you are slightly complex to follow, if it is easy to follow, and if you are finding difficulty in following that also, you can vote for that. So here people, those who have voted for that, so 70% of the people, those who are getting the report, so those people only would have voted. So 70% of the people saying that voted for that. So out of those people, only 22% of the people saying that they are finding it difficult. So but we will be slowly, if you have any particular difficulties, put it in the email and we'll change that report to a format which you can able to understand it easily. So this is how the 1SD concept is working. And I'll just spend couple of seconds to explain our products. Smart Finance is having, these are the listed products of Smart Finance. 1HD software, which many of the users are possessing now, is costing 2,600 rupees per year. It has equity, future, commodity, currency, intraday and positional feature into it, and it has a feature of options intraday only. So this is what we are getting in this particular tool. And as far as the positional trade is concerned and intraday trade is concerned, its accuracy level is very high, though it is not justifiable to give a exact parameter of accuracy. Parameter of accuracy felt by the users are very high, that much only I can say. And if you wish to possess this software, call to our sales number which is reflecting here and you can get that software for you. And if you want to possess all our courses which has the books, DVDs and softwares, automated softwares, then you can opt for at a discount price of 17,500. So this is about our products and services what we used to give. We do not give any call services or the recommendation services in the via SMS and all. So you want that, you should be recommendation free, and you should not take recommendation from anyone. Things top 5.0, this is the updated version. If you are running any outdated version, so which is not 5.0, then please update it. You will be alerted here. Same link which we have sent to you earlier along with your user ID and password, using that to track your experiments in this. And if you are not updated the software, just uninstall the old one, install the new one, you download from the same link which is already given to you and try to install, so it will work.